Welcome back to the channel. My name is Brad, and today we're going to talk about down markets, what you can do and what you might think about. If that's what you're looking for, stick around. So my name is Brad, and I've been retired now for over a year, and I started looking at this going, what do you do in a down market? Last thing you want is your account to go down, 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 all the way down and just drop off the face of the earth. But there's a bunch of ways that you can actually make money in a down market if you're willing to take a little more risk out there and hedge the downside. Or is it actually risk? And we'll talk about that. Let's go ahead and think about, what do you know when to do it? That is the biggest question. Because if you don't know when, you're just putting money chasing. You're just chasing. So stop chasing. Let's talk about this in a little more detail. Inside my circle group, I run a little confirmed calls. We got the confirmed call way back on October 6th. I do believe it is. It's marked on the little chart here on the red line. That's when it said confirmed call. I did nothing. I sat there and said, wait a second, everybody. It's above the 20-day moving average the next day. We had a big jump in the market. So I did nothing. I actually waited for it to start to come back down. And then once it crossed the 20, I started to put a little hedge on. And then when it crossed the 50, I put a little more hedge on. But that was just me. And we'll talk about what I did and what I was thinking. If the market continues to move the way that it is, we could see another 6% drop. I wouldn't be too surprised that it drops another 6%. That's really close to the 200-day simple moving average, but we don't know what's going to go on. We have the Japan carry trade, we got home loans getting foreclosed on at highest rates, auto loans getting foreclosed on. Anybody that thinks the market is doing a good thing, well, we've really been just hyping the AI boom. But now we're seeing a little bit of drawback. Now the bigger picture is the market will go up over time. It will always go up over time. It's just the fact that it's going to pull back at times, and it's pulling back. Now, one thing I'm looking at inside the circle group is when it actually hits the 125 simple moving average, and I'll increase my hedge. That is what I'm doing inside the circle group. And you can always join the circle group if you choose to do so. We talk about all things income investing. So number one, what is the first thing that you can do? You can buy a put. You can buy a put on MAGs. And that's exactly what I did. I bought some puts on MAGs. And then when it hit the 50-day, I bought some more puts on MAGs. And I did extremely well. Now, one thing there is I sold those the other day when I thought the market was going to start to correct. But I also bought YQQQ. Maybe if the market continues to go down, I'll buy a couple more puts on MAGs just to collect a little more revenue. And then I'll just reinvest that back into one of my income funds. When the market is going down, the puts are going up in value. That is the simple thing of buying puts. Now, buying puts isn't for everyone, and I get it. Not everybody's comfortable about buying puts or selling puts or doing options trading. But I bought some puts on MAGs, and I did extremely well. So what's the second thing that you can do? The second thing you can do is buy a fund that actually has puts in it, like QQQH. First one that comes to mind. They actually have some put spreads, and you can see by the chart, it's inside the put spreads right now. So you're getting downside protection inside the fund. Now it only pays 9%, but maybe one day Brad might own this fund. I have some thoughts in my mind that I might buy some QQQH in the future. Not going to spoil the surprise of when I do it and why I do it. But QQQH actually has downside protection built into the fund. What's the third thing that you could do? You could look at something like KQQQ, which I recently purchased a little bit more of KQQQ. They have puts on MAGs. And if you see that 65 put Well, that one's actually in the money. So you're getting some downside protection right now inside of KQQQ. Just something for you to be aware of, that some of these funds have puts in there, so they give you downside protection. What's the fourth thing that you can do to hedge the downside? Well, you could buy eggs. I've been buying eggs for the last couple weeks. I've been buying eggs here and there to hedge the downside because I knew that they had downside protection in there. And if I look at their puts that they have right now, a lot of their puts are actually in the money. So when I had my mags puts, I sold those off for a profit and put them into eggs to get that eggs distribution. The fifth thing that you could do, which I am still doing now, is I own YQQQ. I don't always own this, but when the firm calls and things are moving correctly, I decide to put a little bit of money into YQQQ. This is my yield max. What they do is they're hedging the downside. Looking at a chart, you can see where the confirmed call was. That is that red line. And you can see that the price of YQQQ is going up. And they'll give you a distribution on top of it weekly. Now you can take that distribution, like I'm going to do, and I'll put it back into different income funds for the long term. And when I get a signal of take the hedge off, I'll sell YQQQ and I will just use that money to invest in something else at the time. But that is just a strategy that I came up with. You can do YQQQ. If you look at YQQQ in February and May time period, you can see that it actually did very well during the April downturn. And that's why I started to go looking for YQQQ. But at that time, it was only paying monthly distributions. Now it's paying weekly distributions. So it just makes sense that I could hold it for a week or two, get the distributions, just hold it through X dividend date and get the distribution on it, and then sell it if I need to sell it. But it's one of those things that you can do to actually hedge the downside, because the actual price, the NAV, tends to go up during these time periods and not go down, so you don't see your account going down as fast. What's the sixth thing you can do? Well, you could buy QID. This is another one of those funds that are an inverse fund, but it does not pay you income. You'll actually have your value go up, and then you can sell it. If you want to do a trading style in buying QID to actually hedge the downside. Not everybody should do it, but it is available for everybody to do. The seventh thing that you can do, and this is the last one, is you could just hold a little more cash. You might want to sell some stuff that was at profit when you got the call and have a little more cash sitting on the sideline to buy back in later. And that's something else I also did. I got rid of some of the more riskier leveraged funds and I went to cash, so I didn't have to see my account go down as far. Having leveraged funds in a downward market could really hurt. That's what I ended up doing. I end up holding a little more cash. Now I still have a little more cash that I'm going to deploy as the market goes down and buy down as I go. But it's just something for you guys to actually consider. When the market's going down, you might want to buy the market going down. You might want to hedge the market going down. You might want to hold a little more cash when the market is going down. You're getting paid distributions, and I get paid distributions almost all the time now. And those distributions just go into cash. And if the market's going down, I'm waiting for the market to go down and waiting for that confirmed call to go back up. But that's what I'm personally doing. And if you'd like to join the Circle group, feel free. Here's a link to it. And until next time, God bless.